Welcome to World Business. Well, what a week it's been for global markets. Disarray, volatility and confusion following a dramatic escalation in the US-China trade dispute. Washington's decision to impose tariffs as high as 145% on a range of Chinese imports has prompted an immediate and forceful response from Beijing, which introduced countermeasures including up to 125% duties on selected US goods. The reaction on Wall Street was swift. The Dow Jones suffered a drop of over 4,000 points across just 2 trading sessions, its worst performance since the early days of the pandemic. The S&P 500 and the Nasdaq followed suit, bouncing around amid rising market turbulence. China halted exports of several rare earth metals essential to high-tech manufacturing, dealing a blow to sectors such as electronics, defense and aerospace. Meanwhile, shares in Boeing took a hit after Chinese regulators reportedly advised domestic airlines to delay accepting new aircraft deliveries. Well, as the world's 2 biggest economies then both batten down the hatches, the battle is beginning to reshape global trade flows and investor sentiment alike. Well, joining me now to dive deeper into this topic is Steve Dickens, CEO of Hyperframe Research in New York. Steve, great to speak to you as always. How are the latest export bans from Beijing then affecting global supply chains? Are we seeing a real shift away from China, do you think?
Well, Guy, I think it's going to be interesting. I think we're still really early. We're looking at a multi-month, arguably a multi-year strategy by the Trump administration play out in a 24-hour news cycle. So always tough to sort of analyze the bigger, longer trends. I think from the tech sector, supply chains, particularly out of Taiwan for semiconductors, that's going to take multi-years to relocate. Ideally for the Trump administration onshore to the US. So that's going to be the first challenge. We saw NVIDIA announce this week that it plans to manufacture some of its chips in the US, but that was a $500 billion announcement. So we're talking significant investment. The lithography, the techniques, Taiwan Semiconductor, obviously based in Taiwan, given the name, has had a march on that and the cutting edge. We're seeing others. Samsung have got presence in the US. There's others, Global Foundries, Intel obviously doing things there. But that's going to take years and years for that to relocate as an entire industry to the US. Those are huge multi-$100 million, often billion-dollar plus investments by those chip manufacturers. So it's going to take a while for that onshoring to the US to happen. I think as we go into earnings season, we're going to start to see some of that projections coming through. But we're at the really early stages of this, and we're trying to analyze it through the lens of a 24-hour news cycle.
Steve, one of the things that's quite difficult because there's so much volatility, so much uncertainty, is kind of keeping track of the winners and the losers as this battle plays out. How exposed do you think Western tech firms are if China keeps tightening its control over rare earths, for example?
So that's obviously a fundamental risk across the entire sector. These chips require these rare earths. I think China's going to be pragmatic there. Ultimately, threats and what they do may be different. But we're starting to see this bifurcation. We're going to see these 2 paths diverge. You're going to see manufacturers like Huawei and local manufacturers start to dominate in the China market. I think US-based tech companies are going to look pragmatically at what they do with regards to investing in China. But there's a balancing act here. I think it's going to be really interesting. I think we're going to see some saber rattling. We're going to see some chest pounding from both of the administrations, both China and Trump's. But it's going to be really interesting to see how that plays out. But as I say, we're looking at this through the lens of a daily news cycle. You guys have got to publish on the daily, even by the hour. but we're looking at something that's got implications for the next decades to come.
Yeah, indeed. And as everybody has said, it's so hard to make predictions in this volatile market. But which tech stocks in particular do you think could be the likely winners and losers over the next 12 months?
So I'm not a stock picker. I'm looking at those fundamental trends. I think the picks and shovels companies from the AI trade are always going to do well. We're at a tectonic shift. So the likes of NVIDIA, those cloud hyperscale providers. So I think there's some headwinds coming for the industry as a whole, but those guys look like they're going to be well placed to just ride the wave of AI. We're still really early. We're 2 years into this now with AI, and we're talking about a trend that I consider to be the same as like where we were with the internet in 99, with mobile technology in 2007, where we've been with the cloud over the last 18 years. This is one of those long mega trends, and we're 2 years into it. So I think those picks and shovels companies, some of those other names that I would look at, I think I'm seeing private cloud. I published research this week about some of the private cloud providers. That's the HPEs, the Dells, the Lenovos, with what they're doing. So I don't see all the AI trade going to the hyperscalers, although they're going to capture a lot of it. So I think looking at some of those names, AWS, Microsoft, Google just had their event last week, Google Next, 229 different announcements, most of those around AI. So that's going to be foundational. I think they're catching back up and starting to really invest in this space, and they're a juggernaut. So I think I've name dropped a few there, Guy, but I think for me the underlying piece would look at the fundamental AI trend, look at the picks and shovels companies that are going to benefit from that trend. And we're talking a 10, 15-year cycle with regards to AI investment. So think about that over the long term as you're looking at portfolio construction and particular investments.
Very interesting indeed. Stephen, thank you very much indeed for joining us. Steve Dickens there from Hyperframe Research in New York. Now, gold prices have surged to a historic high on the COMEX exchange, breaking records again this month. The previous peak was set just days earlier. The rally comes amid mounting global uncertainty, with investors flocking to gold as a traditional safe haven asset. Economic volatility, geopolitical tension, and shifting interest rate expectations continue to drive demand. Now, some analysts project the precious metal could climb even higher by the third quarter, reinforcing gold's role as a barometer of market anxiety and strategic hedging. Well, joining me now to discuss this further is Mike Ingram, independent market strategist from London in the UK. Mike, great to speak to you. Let's get into this then. What are the key drivers behind gold's continued rise in value this month?
Well, if I had to summarise it in one word, I'd say uncertainty. If you flip back to where markets were at the end of last year and what they thought was going to happen in 2025, they thought gold was probably going to put on another 2% after what was a pretty good year. But essentially business as usual. Markets seem to have actually been surprised that Trump has delivered on a lot of the things he said he was going to do after winning the November election, which frankly I find absolutely astounding. And under these sort of circumstances where we've had not only record levels of tariffs imposed and then withdrawn, but it's just the sheer volatility in particularly trade policy we've seen coming out of the US, which has helped push gold to yet another all-time high. But I would point out that this latest leg up that we've seen in recent months is actually part of a longer-term story of essentially the rehabilitation of gold as an investment asset. It was out of favor for very many years. It was, regarded as what John Maynard Keynes would say, a barbaric relic. And everybody was very much focused on equities and fixed income. I think the key point ultimately was 2022, where everything other than pretty much gold went down and there was no place to hide, not even in Bitcoin, which was supposed to be, an uncorrelated asset. So yeah, as I see, I think this is just another stage in gold. You're looking to see where the demand is coming from. It's coming from central banks. They've put another 1,000 tons of gold on their books in the last year. I suspect they're still buying gold. We're seeing more investment in gold bars and coins and so forth, and that's helping to support the price, no doubt about it.
And there's lots of factors there, Mike. But what's having the biggest effect? Is it the instability, the market volatility? Is it monetary policy? What's the thing that's really making the difference?
It's difficult to separate one out from the other. I mean, certainly, in recent years, you would have just said, oh, the market's in turmoil, the Fed is going to cut rates, and everybody gets bailed out. So we don't need to look at gold. That, I think, has really been blown up quite comprehensively as an investment strategy. That sort of buy the dip, the Fed put sort of strategy last year, because, of course, there were some very aggressive rate cut forecasts out there, and they largely didn't materialize. The rate cuts were sort of end weighted in the US, and we probably got 3 or 4 cuts less than the market was really expecting. And that prevented a lot of institutional investors in particular that run sort of multi-asset portfolios. It prevented them from rotating out of what everybody thought was an expensive stock market into something like bonds. But that didn't happen. Inflation's been sticky. Fed hasn't really totally cooperated. So it's meant that if you're going to look outside of stocks and shares, if you can't really yet rotate into bonds, where do you go? And gold has definitely been a beneficiary of this. And in terms of, so as I said, it's difficult to separate the fundamental, but obviously the volatility is being generated by policy making. There's very little visibility as to what's going to happen. I mean, just anecdotally, and I'm working on a piece looking at Trump trade policy at the moment, and I've got a deadline at the end of the month. There's no point in me writing this now because I'm probably going to be rewriting it next week. So I'm probably going to wait until right at the end of the month, write it then, and then pray that nothing changes while it's going through the editorial process. That's the kind of world we're living in at the moment. It's interesting because if you look at the recent Beige Book summary in the US, sort of gauging overall economic conditions, the word uncertainty cropped up a record number of times. And what happens in that environment? Well, traditionally people might go into bonds, but under these circumstances, they've gone into gold.
Mike, I appreciate you're going to wait till the 11th hour to complete that report, but as you're looking around at all these different conditions, have you seen anything that might indicate a correction coming anytime soon? Or do you think this momentum, this trajectory is going to be sustainable through the third quarter?
All right, well, first of all, caveat, this is not investment advice. I'm just looking at a chart of it, which I know a lot of other investors do, so there's a certain circularity to, fulfilling expectations. It does look overextended at the moment, and it's kind of interesting to see gold continuing to make headway in what hasn't been a bad week for risk assets. I know the US has come off a bit softer right now as we speak, but actually, if you go back a week, it's actually not been some pretty decent performances. That said, I mean, if this 90-day pause in the majority of the tariffs doesn't last, as Trump has already indicated it might not, and particularly if some of the reversal of the technology tariffs is reimposed, then all of a sudden, all bets are off. I mean, the degree of uncertainty is very, very high indeed. All I would say is tactically, if I had to make a bet on where it was going to be, probably in a week's time and where it is now, it might come a bit lower. But I think, as I say, strategically, this is part of a multi-year story on gold. I think it is taking its place once again, as it used to, as a core part of institutional portfolios. And I think, you'll see people like entities like central banks continue to add to positions. So as always, it's, keep an eye on the prize, but, you have to also keep an eye on the door and be nimble on your feet.
Yeah, Mike, you mentioned central banks there. Lots of interest from individual investors, lots of interest from institutional investors. But do you see central banks still adding to their gold reserves then at the same pace?
Yeah, I mean, I think that the numbers we've got at the moment indicate that central banks bought over 1,000 tons of gold last year for the third year in a row. And certainly, bringing yet another theme, which is this de-dollarization theme, and central banks not being quite so dependent on the US dollar in terms of the reserve assets. I think, yes, there are long-term supports and drivers, and certainly, in terms of debasement of the currency. I mean, they've got this old argument of, the US is printing money. Everybody seems to be printing money, but the supply of gold is extremely constrained. Yes, I mean, you had the gold supply. I think it increased by 1% on mining last year, and most of the net supply came from recycling. So there is significant supply constraint. There clearly is buoyant demand from a number of directions, principally from investment. So yeah, I think over the longer term, that is something which we're going to continue to see. And actually, you had a report released, I think it was October last year, from a poll of central banks, and the central banks themselves foresee continuing to diversify their reserve asset holdings away from dollars, and gold is going to play its part in that.
Mike Ingram for us there in London. Thank you very much indeed for that analysis. Thanks for joining us.
Pleasure as always.
Well, up next, let's have a look at how the markets closed this week.
From why a tariff tit for tat just might have peaked, to why gold is looking ever more shiny, this is the week in numbers. 145% might be as high as US tariffs go on China. Donald Trump said Thursday that he didn't want to go any further, and could even think about bringing the duties down. He said he was hopeful he would strike trade deals with China and the EU.
I mean, everybody wants to make a deal.
$5.5 billion is the total charge being taken by Nvidia over US curbs on its sales to China. Washington has now restricted exports of its H20 AI chips, previously the most advanced models still permitted for sale to China. Nvidia says US officials are worried its products could be used to build supercomputers. 0.25 percentage point was the cut to rates by the European Central Bank, marking its 7th reduction in a year. Bank President Christine Lagarde indicated the bloc's economy needs help amid rising trade tensions.
Downside risks to economic growth have increased.
Trump called on the US Federal Reserve to do likewise, blasting Chair Jerome Powell for being too slow to cut rates. 5.4% was the jump in China's GDP over the January to March quarter, better than analysts expected. But economists say the numbers were probably flattered by a surge in exports as shippers rushed to beat US tariffs. They say the figures could plunge over the months ahead as Trump's levies kick in. And over $3,300 per ounce was the fresh record high hit by gold. The precious metal is soaring as investors seek out perceived safe havens amid the market turmoil. Since gold is priced in dollars, it's also been boosted by the sliding greenback, which makes it cheaper to buy for investors holding other currencies.
Well, that is all we have time for on this edition. Please stay in touch with all the latest business news on anews.tv and across our social media channels. And join me again next week for more World Business.